Hi, everybody. My name is Nick from Fortune DNA, and with all the going-ons, I could not help but take a couple minutes to do this short video for you out there that are real estate investors in regards to this new Trump tax plan that's getting ready to come underway. Guys, if you look, you can see I'm wearing a t-shirt and it says "Bah Humbug," because guys, if this is supposed to be a Christmas present, we don't want it. Send it back. But unfortunately, we're going to have to live with the dredge that's going to come from it. In order to help you guys survive this next year and the coming years, because it's going to be embedded into our plan and our way of life, the way that we deal with real estate, dealing with this new plan, we wanted to give you some insights as to some of the things that you can expect, along with some of the workarounds that you can participate in order to benefit from and not get surprised about the different things that are going to come your way. So what I wanted to do is I want to go through here and I want to do a short presentation for you guys. And I want to have us look at this and get an idea of some of the different aspects that you can understand that are going to be shaken down from this and how you're going to be able to deal with them directly. So first of all, let's start off from the top. Elimination of the state and local tax deduction. Guys, this is going to be killer. If you're in a state like California, if you're in Illinois, if you're in the East Coast, if you're out of New York or some of the other high tax-paying states, it used to be that you could deduct your state and local taxes against your federal taxes. For example, if you were in California, after your first $40,000, you were taxed 13.3%. And what you could do is by paying your state and local taxes, you would then pay those taxes and then deduct them further against your federal income tax. You can no longer do this. So let's go down to regular math so you guys can get an idea of what is coming your way. Let's just say you have a giant cake, and the cake represents all the money that you're going to make and be taxed on this coming up year. So it makes up 100% of your earnings. And let's just say you paid 10% in state income tax. What you would do is you would pay your state income tax, pay that 10%, and then subtract that 10% from your 100% and pay taxes on the other 90%. That is no longer the case anymore. You will pay your state income tax and your local income taxes, and then you will further pay your federal income tax. You will pay tax on that money twice. Now, it is not a double taxation because it's two different types of taxes. One is a state tax and one is a federal tax. But as far as your pocketbook goes, you will see paying more money because you will be paying for your state income tax, then not be able to deduct it against your federal income tax. This is a major killer. Here's another thing that's going away, line item deductions, but the standard deduction is going up. When I say line item deductions, most real estate investors rely on line item deductions in order to deduct against their tax bracket or reduce their tax liability. The standard deduction used to be $6,050 for an individual. It's now been raised to $12,000. And it used to be $12,700 for a person filing joint, and it's now been raised to $25,000. And you say, well, what happens if I have $20,000 in line item deductions and I'm filing all by myself? What happens to that other $8,000? Very good question. You will pay tax on it. This is not an incentive, obviously, to buy more real estate. So it begs the question, what were they thinking? I have no idea. But it gets worse because property tax deduction is limited to only $10,000. Now, if you're in a high state property tax state, like, for example, Texas, and there's a few others out there, you might own 5 or 6 or 7 houses, and you already pay more than $10,000 in property tax. And then you will say, well, what happens if I have to pay $40,000 or $50,000 in property tax? I'm used to deducting that. Well, no more. It is gone, guys. It's been eliminated. Now, look, we can go back and forth and you can say, well, this is still being debated between the Senate and the House. These are line items that have been tacked in there. Now, we know that they're taking place. We don't know what the total amounts are going to be. They might change a little bit here or there, but as far as the aspects, the types of deductions that are going away, or the various types of eliminations to take place, we know what those are. We just don't know the exact amount. So guys, get ready to hang on, because it's only going to get worse from here. Elimination of the state and local tax deduction called SALT. When you guys were talking to me about SALT, state and local taxes, that's what that is. That's just a reiteration. What I want to get back to this on is it's not just your state income tax, but also your local taxes. So when you go and you pay for that car purchase, or you go buy that food or groceries, that local tax expense that you pay, you used to be able to deduct that as well. That is also gone. Now, one good benefit is you will see the repeal of the alternative minimum tax. This has been a killer a lot for investors. AMT, 35% on the first 100, 28% on the second 100, and 24% tax brackets on every $100,000 after that. This should have been long gone for a long time ago, but it's something that, thank goodness, is finally taking place. Here's one good point that is happening. For all you out there that have minions running around the household, you will be able to deduct more for them. You're going from $1,000 deduction to $1,600. There's an extra bonus in there if you're taking care of a dependent, could be somebody older or somebody else's child. You get another $300 credit for that. So that's a pretty good thing. The elimination of the estate tax. Now, this is going to either be raised to $11 million with it phasing out hopefully completely. But guys, I still want to warn you, that does not change whether or not you need to have a trust done. Remember, if something were to happen to you and you become incapacitated, or if you have vendors or tenants or other things like that, who's going to access the money, who's going to delegate the money, and who gets what, when, where, and how much? This still needs to be part of your planning. So you guys need to take the time in order to do that. So this is imperative, that just because the trust and the estate tax is being eliminated does not mean that you do not do the preparatory work to get your trust and estate planning done, so that you know, again, who gets what, when, where, and how much. So there's a lot of business deductions going away. About 138 deductions are lost, about 55 tax credits. If you are a sole proprietor and you are watching this, guys, you will absolutely be killed. I don't care what your CPA says. If he tells you that you don't make enough money to work as a business, ask him if he's going to get out his own wallet and pay for all the deductions that you're losing because you're not working as a business. Sole proprietors, guys, you will absolutely be killed. Not only do you not have any protections under these laws, not only are most of the deductions no longer available to you, it makes no sense paying self-employment tax from $1 and all these unnecessary taxes that you pay as a sole proprietor that you do not pay, or pay on a limited basis by being set up as a proper entity. Guys, pay attention to this one. Very important. Your professional that should be your professional that you go to for your advice, that should be giving you good advice, is not talking about a law that's been on the books since about February and is getting enacted and going to be enforced for all of you not compliant by December 31st of this year. That's right, I said December 31st of this year. The code relates to U.S. Code 266226. We're going to talk about it in a little bit, but if you are a single member LLC, or you are a partnership, or a single member disregarded entity, you have to have a special agreement done and special paperwork done assigning who will be the party to be contacted by the IRS in the case of an emergency, in the case of an audit, in the case of wanting information. And it is critical that you have that. That document is notarized, and it becomes a part of your books and your ledgers. We're going to get to that in just a little bit, but if somebody tells you that you don't need to worry about it, trust me, you do. We've talked to IRS forensic tax auditors that cannot wait for this new law to come out there, because it's going to be a quick money grab for all the liens and penalties and punishments that they're going to apply by not conforming and being compliant with this law. Guys, taxes are not going down unless you are someone like a W-2 wage worker. If you are a wage earner and you make $60,000, $80,000 out there, family of four, and you get your first $25,000 out there tax-free, guys, fantastic. But for most of you guys watching this that are investors, maybe you do work as a W-2, but you have this whole set of income that's coming outside of your W-2 income. Guys, it used to be if you were making really good money, and let's just say that you were at a 25% tax bracket, if you did some kind of planning around that, you didn't pay at that 25%. You might pay at the effective tax rate. What you would really pay is on 17%. And you would be able to pay less taxes and keep more in your pocket. But people today, with the fact that the brackets have gone down and your deductions have gone with it, even though those brackets are going down, you will actually end up paying more in taxes. And I ask people, so how are taxes going down for everyday Americans? Guys, you need to tell me, because I don't see it anywhere, and no economists see it anywhere. I don't see how this is going to be a benefit for anybody out there. And as far as real estate investors, you're going to have to change the way that you do business, or you will find yourself the one without a chair when the music stops. So let's look at an example here. If I took the old plan and I had $80,000 in income versus the new plan with $80,000 in income, let's say I have $10,000 in line item deductions. That's that lid right there. There's no more line item deductions, guys. It's gone. Under the new plan, the line item deductions went bye-bye. I've got $10,000 in property tax. They put that cap on there, but let's just keep apples to apples. But now I've got other deductions. I can take other deductions, other interests, other expenses, other things that I do as a part of my property or whatever. Guys, most of all those things are gone now. I can't get those deductions, or they're going to be categorized where I'm going to be put into separate divisions, and there's going to be limits on what those amounts for those deductions are. Now, I've got a $5,000 mortgage interest that I can deduct. Maybe I still get that today, but here's what it looks like at the end of the day. $35,000 under the old plan at a 15% rate versus $53,000 at a 25% rate. Yes, guys, math is everything. Under the old plan, I'd pay around $52.50. Today's plan, guys, $13,250. You will pay more, guys. Why would you rather pay 35% in taxes on $100,000 when you can possibly pay 12% on 4 sets of $25,000? What are you talking about here? When you're doing your real estate work out there, you might just have to break up your investing into divisions, maybe a sales division, an online division, a marketing, a consulting division, breaking up that money, maybe doing a little bit more paperwork, a little bit more bookkeeping. Yep, you might have another set of filings to do, but at the end of the day, guys, look at that spread. It's tens of thousands of dollars savings in your pocket, depending on how much you make and how much business that you do. Guys, it's something to definitely think about. But again, going back to what I talked about, every business owner must do before 2017 is over. Guys, if you have one of these single disregarded entities, it's important that your documents need to be amended before December 31st. I wanted to break down some of the internal guidelines of the IRS for you. IRS likes to penalize non-compliance, guys. This new plan is called the Centralized Partnership Audit Regime. Think about that. The Centralized Partnership Audit Regime. I don't know. It sounds like something out of Star Wars. Sounds like something out of Stalin. Guys, I mean to tell you, they are serious about this. If you are a single member disregarded, even if you have partners, multiple partners inside of an entity, they want to know who is the point of contact. Now, that person has to sign a document stating that they are indeed the person of contact. Now, they can reassign that to an attorney or a CPA or a tax attorney or a tax professional down the way. But if you don't make this decision, the IRS makes this decision for you. You do not want that to happen, because if they pick the weakest link in the armor to start getting information and they do not have the information, you've got all kinds of compliance and commingling and other issues that are there. Now, here's the biggest thing, that even if you opt out of this thing, if you go in there and you opt out, you have to opt out every year, and it throws up a red flag to the IRS if you go and opt out. especially if you go and opt out into a Wyoming entity. So guys, if you're out there, one of the hottest hits audits coming up this year is going to be for those of you out there owning Wyoming entities. And guys, I don't need to tell you why it is that they're doing it. It's for the same reason that you think that you went out there to do it, that somehow it protects you and all these benefits and this non-reporting. Well, I can tell you there is something you need to understand. Wyoming shares information with the IRS. Nevada is the only state that does not. It's actually not in its constitution. It's not even in its revised statute. It is the only state that does not share information with the IRS. So if you think that you're going to opt out of this, or if you think you're going to opt out of this to a Wyoming entity, or if you have a Wyoming entity, you better be on guard, guys. I'm telling you, they're there to come after you. It's a quick grab of cash, and they are going to find that you're not compliant and fine and penalize you, guys. They've made it really clear what happens to people that try to opt out and frustrate this process by moving stuff around and by setting up Wyoming entities and doing all this stuff. They plan on coming out after you, and they're going to review the partnerships. They're going to start reviewing the agreements. Guys, if you're listening to this and you do not have a custom-made operating agreement, you are going to find yourself in big trouble. These templated agreements that all these chop shop entities are doing out there are going to do you a huge disservice. You can no longer work under these templated entities. You have to build agreements specifically for the way that you do business, and partnerships for the way that you do business, for what you invest in and how you invest into them. You cannot have these cookie cutter companies go out there that have taken some other company's name off and put your new company name on, and took the owner's name on and put your name on it in its stead. Guys, you cannot do that anymore. You have to have things built specifically for you, and unfortunately, you are running out of time. This has to be done by December 31st, and because we know that, we're making it so that we can do these documents for you. We have the know-how, we have the education, we have the documents that are compliant in order to do this. But you need to reach out to us. 702-637-4040, 702-637-4040. You cannot dawdle. You've got to stop being passive about this and thinking, oh, well, it's holiday and I'm busy and I'm going to wait. You've got to have your paperwork done, time and date stamped through a notary before December 31st to ensure that you do not have fines and penalties. It's very important, guys, that you take care of this work. Do the things that you need to do now to be proactive. Our number, again, is 702-637-4040. If you're interested, you can email us at nick@fortunednagroup.com. That's nick@fortunednagroup.com, or click on the link below. It's going to take you to a landing page that will populate the information that we need to know in order to do your documents. Take 5 or 10 minutes. You go in there, you click on your various links in there, select the type of entity, select the year of the entity, things of that nature, follow through the process, click submit, and we will be happy to create this document for you. Guys, you cannot dawdle on this. It is a serious thing. The reason why several of these groups have brought you this emergency session, and we are recording not only for the radio, for TV, and for all of our clients, as well as many of you that are part of other affiliations out there, is because this is not something to take slightly. This is a serious program that is being enacted, taken place since February, but people have dawdled and thought, oh, it doesn't affect me. And now we're running out of time, and it's important, it's imperative that you guys get this handled. So look us up, give us a call, 702-637-4040, email nick@fortunednagroup.com if you have questions. Click on the link, follow through the process, go through the landing page, submit your documents so that we can make the proper preparations for you, send you back your documents that meet your compliance. You can put them into your books after you get them notarized. And guys, sleep at night. Very important. I look forward to what this new year has to work for us. Anytime that there are hiccups put into our into our road, guys, there's opportunities that come and present themselves to us. I'm going to show you some amazing things in the next few segments. They're going to blow your mind, how to work around this program and put more money in your pocket and less than Uncle Sam. Be proactive today. We look forward to working with you. Take care.